Tracking inventory is a very complex operation for any business. Let's talk a bit about inventory. In particular, let's talk about some of the definitions. First, I'm going to enter our items list by choosing Items and Services from my home page. You'll notice that next to our name and description, there's my item type. To begin, I'd like to actually go in and create a new item. In our new item, you'll notice right on top, the first thing it asks me for is what type do I want. I'd like to start with talking about the inventory part versus the non-inventory. This is where I find the most confusion with inventory within QuickBooks. Now you'll notice that the inventory part notes that it is goods that we purchase and track. I'd like you to remember that an inventory part is going to hit an asset account, a cost of goods sold account, and an income account. When you purchase an item, it is going to originally go into your asset account, which of course is tracked on your balance sheet. When we sell this item, it will be removed from our asset account and expensed as a cost of goods account. At the same time that we're expensing this out is when we are going to record the income from a sale. So any item that is inventory is going to be purchased and placed in our asset account. When it's sold, it'll be removed from the asset and expensed. This is so that we can match the cost of goods sold with our actual income at any given time in our profit and loss. Now there's a second item that is called a non-inventory part. This is usually a little confusing. The non-inventory part is meant for items that you sell, but you don't want to track them. Okay, for instance, if I have small tools that I have purchased for a particular job, I really do want to charge them for the job, but it's not an inventory item that I sell. It's just a cost I want to pass along. I can put the small tools into my non-inventory parts, and I can actually sell it and record the price as income. What's very important to remember in non-inventory parts is that there is no matching between the two. When you expense the purchase, it just goes into an expense account. When you record the income, it shows just as regular income. So if you wanted to see a profitability report, find out cost against sales, you cannot do that with non-inventory parts. Also, there is not a way to change the items from inventory to non-inventory. So once an item is an inventory item, it is always going to be an inventory item. As a result, as usual, it's very important that you actually think through your inventory system before setting it up in QuickBooks. Let's cancel out of our new inventory and talk about a few more of these actual types. Groups and subtotals, along with assemblies, are going to be handled in great detail in our next movie. These are different methods by which we can group together individual items for a one-line showing on our invoice. There are a number of complexities between groups, assemblies, and subtotals, so I'd like to address that in a separate movie. Other charge is an item that was actually put into play for things such as finance charges. If, for instance, I have a client that has a non-sufficient funds check that I need to charge back, the other charge is a perfect area for this. You'll also see other charges used for items such as delivery charges, setup fees, service charges. Any item that isn't really an inventory part or non-inventory part can be established via an other charge. Service is probably the easiest of all the types to understand. This is labor. This is any direct labor, in this case for framing or site work. Professional fees would come under here. Any kind of hourly wage that we are going to bill our client for will come under the category of our actual service itself. There are a couple other unusual types within items that I'd like to talk about also. Let's return to a new item screen. You'll notice on the bottom that we have discount and payment. Discount gives us the ability to assign a percentage that we may want to reduce our overall invoice charge by. Let's say, for instance, I have 5 or 6 items that I agree to give my client a 10% discount. I can put those items on my actual invoice. If I'd like to total them together separately, I can use a subtotal item. The subtotal will total everything from this point forward on our invoice. The discount will then allow me to decrease the pricing of all those items by 1, 5, 10, 15%, anything you choose. You'll also notice an item that is called payment. Payment is when our client actually gives us some money. This is very commonly used when we have a deposit against an account. Let's say hypothetically that I'm going to contract with you, but it requires a $100 deposit on account for parts. I'd like you to see that $100 that you gave me, and then I'll start charging you the regular fees on the invoice. The payment allows you to actually see that I have accounted for the $100 that you had given me. The payment is an excellent way to record any kind of partial payment that we receive at the time of the sale.